In 1980, two billionaire brothers controlled nearly half the world's silver supply, and when the price collapsed from $50 to $10 in 4 days, it nearly destroyed the global commodities market. The Hunt brothers didn't fail because they were wrong about inflation. They failed because they confused controlling supply with controlling price. That distinction matters today because we're seeing the same pattern play out in commodities, crypto, and even housing markets. When leverage meets scarcity, the crash doesn't care how right you were about the fundamentals. This is Economic Pattern Vault, where we break down financial history to understand how markets actually work by studying how they fail. Each video uncovers the repeating patterns behind economic booms, debt cycles, and power shifts, so you can see what's happening beneath the headlines. If you find this breakdown useful, like the video, subscribe to the channel, and share your thoughts or questions in the comments. In January 1980, silver hit $50 an ounce, up from $6 just 12 months earlier. The price wasn't moving because of industrial demand or jewelry consumption. It was moving because two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, had accumulated roughly 200 million ounces of physical silver and silver futures contracts representing another 90 million ounces. The Hunts weren't gamblers. They were billionaires who inherited one of America's largest oil fortunes. And they had a thesis, one that wasn't entirely wrong. They believed that inflation would destroy the dollar. They watched the 1970s unfold: oil shocks, stagflation, the collapse of Bretton Woods. They concluded that hard assets, particularly silver, would preserve wealth when paper currency failed. So they started buying, not just for investment, for accumulation. They bought physical bars and stored them in vaults in New York and Switzerland. They bought futures contracts on the COMEX exchange. They took delivery when those contracts expired, which was unusual. Most traders roll contracts forward or settle in cash. The Hunts took the metal. By late 1979, they controlled an estimated 50% of the world's deliverable silver. The price climbed from $6 to $10, then $20, then $30. Industrial users, manufacturers who needed silver for electronics, photography, medical equipment, started panicking. They couldn't source material. Premiums spiked. The Hunts kept buying. Here's what most people miss. The Hunts were using leverage. They weren't paying cash for all that silver. They were borrowing against their existing holdings to buy more. As the price rose, their collateral increased, which allowed them to borrow more and buy even more silver. It was a self-reinforcing loop, as long as the price kept rising. But someone noticed the danger. The COMEX exchange, along with the Chicago Board of Trade, saw that the Hunt brothers' positions were distorting the entire market. In January 1980, they implemented what became known as Silver Rule 7. The new regulation dramatically increased margin requirements and restricted how many new futures contracts any single entity could hold. Critically, the rule applied only to new long positions, meaning it targeted buyers, not sellers. The Hunts couldn't buy more, but they were already over-leveraged. Their entire strategy depended on prices continuing to rise so they could borrow more against their holdings. When the exchange blocked new purchases, the upward momentum stopped. Then the selling started. The price dropped from $50 to $42 in a week, then $30, then $20. By March 27, 1980, a day later known as Silver Thursday, the price hit $10. The Hunts faced massive margin calls. They couldn't meet them. Their lenders demanded payment. They didn't have the cash. They had to liquidate silver to cover their debts, which pushed prices even lower, which triggered more margin calls. The doom loop had reversed. The Hunts lost over $1.7 billion, roughly $6 billion in today's dollars. They were forced to sell assets, restructure debt, and eventually filed for bankruptcy in 1988. But the damage extended far beyond their personal fortune. Banks that had lent to them, including major institutions like Halsey Stewart Shields, faced liquidity crises. The entire commodities market seized up. The Federal Reserve had to intervene with emergency credit lines to prevent a broader financial collapse. Here's the repeatable pattern. Leveraged accumulation works until it doesn't. The Hunts weren't wrong about inflation. They weren't wrong about the dollar losing purchasing power. Silver did go up 700% in 18 months. Their thesis was partially validated. But they made a critical error. They confused market control with market immunity. Controlling supply doesn't mean you control the rules. When you become the market, the market changes the rules to contain you. The COMEX didn't implement Silver Rule 7 because silver was overvalued. They implemented it because one entity's position threatened market function. Exchanges, regulators, and central banks will always intervene when concentration risk threatens systemic stability. The second part of the pattern is leverage timing. Leverage amplifies gains on the way up and losses on the way down. The Hunts borrowed to buy more silver, which worked beautifully when prices rose. Every dollar of price increase multiplied across their holdings, giving them more collateral to borrow against. But when prices fell, the same leverage destroyed them. A 20% price drop didn't just reduce their wealth by 20%. It wiped out their equity entirely because they were so over-leveraged. The third element, forced liquidation, creates cascades. When you're holding a massive position and you're forced to sell, you can't sell slowly. You have to sell into a falling market, which pushes prices lower, which forces more selling. This is why leveraged blowups don't decline gradually, they collapse vertically. The insiders who recognized this pattern early weren't the ones predicting silver would crash because it was overvalued. They were the ones watching leverage ratios, margin requirements, and exchange rule changes. When the COMEX announced new restrictions in January 1980, sophisticated traders knew the Hunt position was unsustainable. They didn't need to know the exact top. They just needed to recognize that the structural support, the ability to keep borrowing and buying, had been removed. This pattern reappears consistently. In 2021, Archegos Capital Management controlled massive positions in a handful of stocks using total return swaps, a form of leverage that allowed them to control billions in assets with relatively little capital. When those positions moved against them, banks issued margin calls. Archegos couldn't meet them. The forced liquidation caused stocks like Viacom CBS to drop 50% in days. Credit Suisse lost $5.5 billion. The structure was different, but the pattern was identical: leverage, concentration, forced selling, cascade. The same dynamic shows up in real estate during over-leveraged cycles. In 2008, homeowners and institutions weren't just holding property, they were holding property bought with debt. When prices stopped rising, refinancing became impossible. Forced sales depressed prices further. The leverage that amplified gains on the way up accelerated collapse on the way down. Even in cryptocurrency, we've seen this. In 2022, Luna and Three Arrows Capital collapsed using similar mechanics: leveraged positions, belief in perpetual appreciation, and structural triggers that forced liquidation. The ideology behind each position was different, but the pattern of leveraged accumulation meeting forced selling was the same. The lesson isn't that commodities, stocks, or crypto are inherently dangerous. The lesson is that leverage transforms volatility into liquidation risk. And when one entity's position becomes large enough to distort the market will change the rules. The Hunt brothers weren't destroyed by being wrong about inflation or silver's value. They were destroyed by structural fragility, leverage, concentration, and the assumption that market rules wouldn't change. The pattern repeats because the mechanics are universal. When borrowed money meets forced selling, fundamentals stop matching. What matters is who has to sell, how much, and how fast. Recognizing that shift, from accumulation to liquidation, is what separates those who survive from those who blow up. The Hunt brothers believed they were positioning for the future. They accumulated real assets in anticipation of currency collapse. But they built their position on leverage, and leverage requires liquidity. When liquidity disappeared, so did their fortune. The pattern hasn't changed, only the assets and the names. Understanding that distinction is the difference between participating in markets and being consumed by them. History doesn't repeat itself exactly, but financial behavior does. If this breakdown helped you see the pattern more clearly, like the video, subscribe to Economic Pattern Vault, and share your perspective in the comments. Understanding the cycle is how you stay ahead of it.